Even when you look at like regional manufacturing, right? I mean, regional manufacturing surveys were generally moving up and to the right in the months following the 2016 election. That has not been the case so far. It's been, a really mixed bag. But the Richmond Fed manufacturing, for example, this week was still negative, not really moving anywhere. So I don't think there's much of a Trump bump. And I think, frankly, that makes sense because, this isn't like 2016, 2017. I mean, there's not a stack of papers that, ready for Trump to sign. I mean, back then it was pretty clear what the agenda was going to be because, frankly, Trump was coming in and, Paul Ryan had a agenda for corporate tax reform that that he was spending his, frankly, his entire political career trying to get through. And Trump needed an agenda.
Welcome to RenMac Off Script, where we often discuss markets, economics, policy, history, and life. It is the 27th of December, 2024. I'm Jeff DeGraff.
I'm Neil Dutta.
And I'm Steve Pavlik.
We're going to touch on this week the consumer confidence issue, single-family housing, Doge versus MAGA in terms of immigration, the oversold bounce that we got, but the lack of momentum. But I need some personal opinions here, guys. I'm going with the Gen Z microbrewer hat. I don't know if that's the right one. Maybe I'll go with what do you think, the ski bum hat. I think that one's going to be a little too hot. And then we can go with the Colorado cowboy. I don't know. Any thoughts? Talk to me.
I like the cowboy hat.
Personally. All right, here we go. Hope I don't. I think it's actually rude. You can wear a cowboy hat in a bar, but you're not supposed to wear a cowboy hat inside otherwise. So I guess, pour me a whiskey. Here we go. Neil, I'm going to talk to you a little bit about the single-family housing because I know you're concerned. And I bring it up because we do have, within the context of the market, right, housing has done extraordinarily well. Housing stocks, I should say, has done extraordinarily well over the last 3 years. We have a proprietary model that we run. We call it SERM. It stands for Standardized Excess Return Model. It's essentially measuring the return above and beyond what you'd expect versus the market, and we volatility adjusted, so it's basically an alpha play. And look, we've had, or housing stocks have had, as good of risk-adjusted returns over the last 3 to 5 years as they've ever had, and that includes going back to right before the housing peak of 2006. I don't think you believe that we're in a 2008, 2009 environment for housing. I certainly don't believe that. But where are we in terms of what's happening to the overall data? How concerned are you, and how should we be thinking about housing here?
Yeah, sure. So, I mean, I don't think we had the kind of overbuilding that we had during that period, and certainly not the kind of price momentum type dynamics, right? Where, basically expectations for prices kept going up and people saw housing as a really good investment. So they wanted to get in before prices went up even more. I don't think you have that dynamic, but, for me, it's really about our conditions in housing getting better or worse. And I think it's pretty undeniable that conditions are getting worse. So a couple of things that we're looking at. I mean, number one, if you look at completed new housing units for sale, single family, that number is up over 50% against last year. So that means that there's increasing slack in the single family residential real estate market, right? So for builders. And that means that, ultimately, they're going to have to cut price and stop building to move that inventory off their books. Similarly, if you look at homes that have been sold but not started, that's down about 5% against last year. So, the outlook for residential construction spending, I think, is getting worse, not better. When you look at home sales, the 30-year fixed rate mortgage is pushing up to 7.2%. That's about the highest it's been since, I think, the summer, maybe June, July period. I think it goes without saying that housing cannot work with mortgage rates that high because no one's making that kind of money annually. I mean, no one's seeing a pay. I mean, it would be one thing if wages were running 7%, but that's not the case. Wage growth has generally been slowing down, and also inflation expectations have been slowing down. So it's a problem that rates are going up, even as year ahead inflation expectations, both for consumers and businesses, have been coming down. So in other words, that's a big increase in real mortgage rates, real interest rates. So I think, the stock market notwithstanding, I think financial conditions are actually tightening. And I think that's going to slow the economy down in the first half of the year. And I think it's going to be very obvious, I think, in the housing data.
Do we have the data? Is it really available on what percentage of mortgages outstanding are in the adjustable rate camp? And it's even more nuanced than that, right? So, and I just say this because going back, 5 years, we're looking at the 5-year anniversary of COVID right here in the next couple months. I, for one, have a mortgage that's below 3%. That's going to reset in 7 years from that day, right? So I've got another 2.5 years essentially before that happens. But I think there's a lot of 5 and 7 year arms out there that are going to reset from this 3% to, as you say, 7 plus. That's a big, big problem. I mean, do we know what percentage that is, or am I kind of the outlier at taking that fixed rate for 7 years and then readjusting as it goes?
I mean, it's a lot lower than it was at the height of the 2005 sort of mania. I mean, I think it was like 30-40% of the of outstanding mortgages. I think it's closer to 10% now. So it's
Wow. Okay.
it's a lot lower. So
That's substantially lower, right?
yeah, I mean, most people took advantage of low mortgage rates and locked in for a long time. Can't say the same for the government though, which sort of issued more debt at the front end. But hey,
100%, right? Unbelievable. Well, let's talk about the government and some of the strife that's taking place, Steve. First we had Elon versus MAGA on the budget and the fiscal side. Now it seems that we've got Doge collectively against MAGA on the immigration side. Is this a theme that we should prepare ourselves for? And how long does this honeymoon last? Maybe it's already over before we start seeing more fissures between, who's officially in charge, which I think it's still Trump or will be, and some of his proponents.
Sure. I mean, the Doge versus MAGA debate, as you mentioned, saw it in the spending bill fight. Now we're seeing it out here with respect to immigration policy. Just sort of reveals some of the divisions within Republicans. And, it was one thing before when Trump was here during his first term, sort of taking their cues from him and responding to social media, I guess, posts. Now you're going to have Republicans also having to respond to posts from Elon Musk and Vivek Ramaswamy. And when you have narrow majorities, it doesn't lend itself well to achieving big legislative achievements. And so I think that's sort of the takeaway from the recent government funding kerfuffle is, probably take the over in terms of time next year on how long it'll take Republicans to coalesce behind things. Probably take the under in terms of results. I think usually DC press corps is very Senate centric in terms of its coverage because that tends to be where most of the deal making is required, just given the small majorities. I think this time it's going to be different. It's going to be the House because Republicans want to pursue most of their priorities through reconciliation. And just because of these very slim majorities, that essentially makes everybody similar to Joe Manchin was for Democrats. And I think that's going to be something that both the press is going to have to get used to, as well as people sort of following the machinations here as to really what's possible and likely to move in the year ahead.
Well, the good news is, I think we talked about this last week. We have our policy uncertainty index, which actually is not ours. It's called the Baker, Bloom, and Davis Policy Uncertainty Index. It's out of Stanford. And look, what's interesting is the more uncertainty there is around policy, the better it tends to be for equities. The markets are pretty good at kind of seeing through this stuff. And so while people on the surface tend to freak out a little bit, it actually ends up being more beneficial for equities than not. And so you could make the case that some of this uncertainty will actually start to reduce the multiple in terms of what people are willing to pay for because of that unknown and that uncertainty. But that historically actually tends to be bullish, not bearish. So we'll continue to watch that. That plays a little bit into sentiment, which I want to get to because I think we had some data from the conference board this last week or this week, and compare and contrast where we are today versus where we were in 2016 when Trump was coming into to office for the first time.
Well, if you look at the conference board expectations data, that number actually hit its lowest level since July. By contrast, in 2016, I mean, that was pressing to new highs after the election. So, the so-called Trump bump, is really not very existent in the economic data. Even when you look at like regional manufacturing, right? I mean, regional manufacturing surveys were generally moving up and to the right in the months following the 2016 election. That has not been the case so far. It's been, a really mixed bag. But the Richmond Fed manufacturing, for example, this week was still negative, not really moving anywhere. So I don't think there's much of a Trump bump. And I think, frankly, that makes sense because, this isn't like 2016, 2017. I mean, there's not a stack of papers that, ready for Trump to sign. I mean, back then it was pretty clear what the agenda was going to be because, frankly, Trump was coming in and, Paul Ryan had a agenda for corporate tax reform that that he was spending his, frankly, his entire political career trying to get through. And Trump needed an agenda. Now, the agenda is coming more from the president himself, right? As we've been arguing. I mean, the extension of tax cuts, how you pay for it, tariffs, deregulation. I mean, the agenda is coming more from the White House this time, and in my opinion, and I think that's going to make for a more challenging kind of environment in terms of getting something over the finish line. Doesn't mean that it won't happen, but it probably will be a drawn out process. And so I think to some extent the enthusiasm is not warranted. I mean, it does feel like any one of these sort of Republicans in New York, New Jersey, California can just blow up an entire deal based on a SALT deduction not going the way they want and whatever else. The majorities are much thinner this time in the House, so they don't have as much as many pieces to play with, I don't think. So it's going to be interesting. But I think in terms of like the enthusiasm for kind of fiscal reflation, I don't really see that.
Trump bump had a completely different meaning back in the 1980s, by the way. Completely different meaning. If we talk about the fiscal side of things, Steve, and we think about what's going on from a political standpoint, where do we stand with, or where does Speaker Johnson stand with his ability to get I guess he get elected, right? Reappointed to the speakership, and if not him, who's next in line? And are the knives officially out yet?
Well, I think what you said towards the end there is probably the most important thing is who else wants the job. There are probably people that would like to run again, whether it's Steve Scalise, the second ranking Republican, Jim Jordan. They both made a run the first go around. I just don't know that the conference as a whole necessarily wants to go through that long drawn out process. Both the process at the beginning, multiple votes to get Kevin McCarthy in there as speaker. People might recall that. That's essentially what we're looking at again on January 3rd. Or then the process led by Matt Gaetz to force Kevin McCarthy out, and then the trials and tribulations that Republicans had to endure as a result. So I think, Neil made a good point about everything being, I think, more White House centric this time. And I think that's sort of a question for President-elect Trump. He can't be happy with the way that the government funding situation went down. That was not a good look for Johnson. To your point about being able to corral the caucus and actually move the agenda forward, and that's going to be really crucial, as Neil alluded to, given the small margins there in moving the tax reform package, which is why I'm skeptical that it's going to get done until the end of the year. That said, Trump may like the fact that he can sort of push Johnson around. I think that's something he's sort of weighing right now is, can this guy deliver my agenda? Probably more questions than answers, given the government funding situation. That said, this guy's basically listening a lot to me. I think that was sort of the thing that caught me by surprise is, apparently it's been reported that Trump had been pressing Johnson to address the debt limit extension, which is going to come next week too, January 2nd, right before lawmakers return. And apparently Johnson sort of conveyed to Trump that politically that wasn't possible. Now there was some miscommunication there, but that doesn't bode well necessarily for moving forward. So at the end of the day, could I see Johnson maybe have some challenges getting the speaker vote on the first ballot or so? Potentially, there may be some votes to sort of protest given his handling of the government funding. That said, if Trump comes out with an endorsement, realizes, look, I don't want to go through this chaos again, that could put my 100-day agenda in particular more at risk here. Just fall in line, get behind this guy. I'm really the one calling the shots here. Then he probably keeps it.
Yeah. Never simple. Never simple. The one thing that we always try to do at the beginning of the year is look at some of the valuations that are out there, particularly globally. We've got what's known as the Buffett indicator, which is market cap divided by GDP. How much is the market cap representative of GDP? And what's interesting is you can't use that data across countries. It's completely different. In other words, that ratio tends to be really almost a randomized dice throw when you look at it. So you have to normalize it, and you have to go through a few different things to kind of look at the history of the data. No doubt, and I know Buffett has talked about this. The S&P is historically expensive in terms of market cap to GDP. I would say we also do it in a way for individual sectors and industry groups. And as you'd expect, semiconductors are where they were back in 2000. So clearly there's a lot of expectation there. You're going to get some of that because of growth. But I think what's most interesting from our perspective is, we've talked about this, how we like technically the setup in Hong Kong. We like technically the setup in China. They look good, but they also have that valuation support. When you look historically at their market cap of those countries versus their GDP, they are underrepresented in terms of the market cap. So I think you've got this margin of safety from a valuation perspective, at least from this valuation indicator, that also matches up with those charts. And I continue to believe that China, Hong Kong are a decent contrarian play for 2025. So we'll see how that plays out. The other thing just to watch out as a probably more of a curiosity than anything else is the 6100 on the S&P, particularly between now and the end of the year, because that's essentially where we started the month. And December has historically, excuse me, about a 74% chance of positive returns for December. And so if we don't get through that 6100, obviously that puts us in that 26% camp, which is negative returns. Does that mean anything for the next year? Not necessarily, but it does speak, in our view, to some of the elevated sentiment that we've got in the market. We've obviously bounced from the oversold condition that we had last week that we talked about. A lot of optimal entries, those have been working. We've had a decent bounce from there, but we've had really no sign of momentum out of that. Now, that's not unusual given this holiday season, but I would say given the elevated sentiment and where we are, in terms of that, it does look to us like we're probably going to continue to see some type of weakness in the first quarter. Again, I think we bounce from here, but we're going to use that as an opportunity, particularly as it applies to beta, as it applies to valuation, to look for those two things to mean revert, beta to come down, value to probably move higher as we go. Neil, do we have payroll next week, or is that the government take the week off because it's a shortened week?
We don't have payrolls next week. It's not about the government taking off. I think it's about the timing between the payroll numbers, but or the survey weeks. But at any rate, we have that on the 10th. Next week, the main event's going to be the ISM manufacturing data for December. So we'll be watching that, and we'll also be watching claims. I mean, quietly, continuing claims just hit another 3-year high. Kind of reinforcing this theme about, even though layoffs are low, as evidenced by initial jobless claims being low, it's getting more challenging for people to transition into work, which is why, the ranks of the continuing claims continue to go up a little bit. So, that's, I think that'll be worth watching. But yeah, ISM's the main event. And then also auto sales will be out for December. And that's another interesting one too, because anyone that's on the fence to buy an electric vehicle should just go ahead and do it now, because we know that the tax incentives are going to go away next year. So you may see a little sort of shifting of activity into Q4 of this year at the expense of maybe next year. So that's also something worth watching as well.
Where does the Fed look at continuing claims? Because you and I talked about this, and I think the punchline, right, is maybe the layoffs aren't as high as hitting the panic button by any means, but the ability to find a job once you've been laid off is obviously extending itself. I know the Fed's not blind to this, but where are they putting that in the litany of indications that they look at when they determine policy?
Well, look, I mean, at the margin, they've in terms of rank ordering things, they've pushed the labor market down, I think, a little bit, and they're kind of on alert for upside surprises to inflation. I mean, that's what the December meeting was about, and the markets, responded, I think, in kind by pricing out rate cuts for next year. Now, as I've said, part of the issue here is that if you're waiting for layoffs to go up, you're probably waiting too long, because layoffs are sort of the last thing that go in the sequencing of a job slowdown. I mean, typically what happens is companies reduce their recruiting intensity first, and then layoffs tend to follow. And we know that hiring rates are low. And so, I mean, that would mean that the next thing would be layoffs. So I think, the Fed is taking a sort of very sanguine kind of view on this. And I do think that there's sort of, I mean, I talked about playing kind of a game of chicken here with the administration, right? Because, parts of Trump's agenda is inflationary. Okay. I mean, tariffs, deportations. Now, I think it's kind of interesting that the Fed's prejudging a lot of this. How do you know that I don't think Trump's going to go and like deport like people that are working in the construction industry first. I mean, I don't know that that's the case. If we're talking about hardened criminals, and for example, it could also just be, I mean, it's Trump. I mean, it could be a rhetorical device. I mean, who knows? I mean, you have to say, I mean, at some level, right? I mean, I don't prejudge things, even if the Fed may be, but I mean, it seems to me you may have to say some unsavory things about immigration to send a signal to potential people that want to come in, right? Like, we're going to have to get rid of your family or something. I mean, stuff like that. I mean, does it sound unsavory? Maybe that's what people voted for, but at the same, you want to have very hawkish rhetoric, I think, up front, if you want to discourage people from coming over in the first place.
Right.
I don't know. That doesn't sound that crazy to me. But, I think the Fed is kind of on alert for upside surprises to inflation when they should be on alert for downside surprises to the labor market, and also downside surprises to inflation. So, we'll see. But next week, just to get ISM manufacturing, and, nothing that we're looking at suggests that, manufacturing activity is about to take a leg up or anything like that. So,
right. Steve, is there anything that happens in DC between now and next week?
Well, we're recording next Friday, probably right ahead of that speaker vote for Johnson when lawmakers return. Keep in mind the debt limit suspension expires on January 2nd, so you'll probably hear more coverage of that. That outlook is moving forward. Again, just to reiterate, Treasury can use extraordinary measures, which are actually becoming more ordinary if you think about it, to prioritize payments to really put off the threat of default until mid-year. So that's something I think we'll hear a lot more attention about next week. I think to keep an eye on too is will Trump make any additional territorial claims suggesting we annex Greenland, Panama Canal. I wouldn't read too much into that. I think that's more about sending a message to those areas in particular, the people governing them, that if you're not doing what's in the interest of the U.S., maybe I'll be more aggressive and make sure that I'll take matters into my own hands. So I don't think it's a coincidence that the Netherlands seized a Russian oil ship circumventing sanctions. I think with the situation in Panama Canal, it's more concern about China and having control of two of the larger ports in that area, from my understanding. So we talk about this concern over fentanyl, other concerns about circumvention with respect to EVs through Mexico. I think that may be more what this is really directed. But again, he has an unusual way of pursuing diplomacy, but doesn't mean it's not effective. So keep an eye out for any of those things that occur.
Wayne Gretzky for Prime Minister?
That's what he's proposing.
Governor!
He doesn't want it. So.
Governor! Governor.
Right, sorry. Yes. Let me get that right. I mean, look, if you can control the game from behind the net, you got to be able to run a country. I mean, changing the game completely. Well, we're going to be watching that 5,700 level on the S&P. That's an important one. We're still in an uptrend again. Our momentum measures are contracting, so that suggests that we're probably more in a consolidation phase than not. But 5,700 will be important to those trend indications, and continuing to watch this contraction in that overextended beta and the contraction in the oversold valuation. So I think those will be important themes as we get into the first quarter of 2025. Well, Happy New Year, guys. It's been a pleasure this entire year. I want to thank our executive producer, Harry Chen, who is always working tirelessly behind the scenes to get things done. Harry, say hi.
Thank you, everybody, to join our RenMac off script every weekend.
Attaboy. Thank you, Harry. Well, join us again next week. We'll be 1 week older, 1 week wiser. Don't forget to follow us on Twitter. We can get some of our highlights, and subscribe to our YouTube channel where we post this, and you can see our beaming faces on a weekly basis. Until then, Happy New Year, and we'll see you on the slopes.